Real estate investors routinely report negative taxable income while generating positive cash flow. This paradox is the depreciation tax shield. The Internal Revenue Service mandates that structures lose value over time, even if market appreciation suggests otherwise. This non-cash expense is deducted directly from rental income, lowering your adjusted gross income. For a property generating $20,000 in net rental income, a $15,000 depreciation deduction reduces your taxable income to just $5,000. If you are in the 32% tax bracket, this single deduction saves you $4,800 in taxes annually. This is not a deduction for actual maintenance or repairs. It is a purely statutory allowance designed to recover the cost of the asset over its useful life. Understanding the mechanics of this shield is the difference between paying thousands in taxes and keeping that capital for reinvestment. Depreciation applies only to the structure, never to the underlying land. Land is considered a non-depreciable asset because it does not wear out. Therefore, the first step is accurately allocating the purchase price between the land and the building. If a $600,000 property sits on land valued at $150,000, the depreciable basis is $450,000. This allocation must be defensible, often relying on local property tax assessments or professional appraisals. The Internal Revenue Service uses the straight-line method for residential rental property, mandating a recovery period of 27.5 years. Commercial property uses a longer 39-year schedule. The annual deduction is calculated by dividing the depreciable basis by the relevant recovery period. For our $450,000 basis, the annual deduction is $16,363. The 27.5-year schedule applies strictly to residential rental property, defined as property where 80% or more of the gross rental income comes from dwelling units. This includes single-family homes, duplexes, and apartment complexes. Commercial property, such as office buildings, retail spaces, or warehouses, must use the 39-year schedule. This longer period results in a smaller annual deduction, making residential investments inherently more tax-advantaged regarding depreciation speed. The depreciation clock starts ticking when the property is placed in service, meaning when it is ready and available for use, regardless of whether tenants occupy it. Mid-month convention rules dictate that property placed in service during any month is treated as placed in service in the middle of that month, slightly adjusting the first and last year deductions. Depreciation often creates a paper loss, known as a passive activity loss. The Internal Revenue Service generally restricts passive losses from offsetting active income, such as wages or business profits. This is the primary hurdle for most investors. If your adjusted gross income is below $100,000, you may qualify for the $25,000 special allowance exception, allowing you to deduct up to $25,000 of passive losses against active income. This allowance phases out completely once your adjusted gross income reaches $150,000. Losses disallowed by the passive activity rules are suspended and carried forward indefinitely. These suspended losses can be used to offset future passive income or are fully released upon the taxable disposition of the entire activity. Achieving real estate professional status is the ultimate strategy to bypass the passive activity loss limitations entirely. If you qualify as a real estate professional, your rental activities are reclassified as non-passive, allowing depreciation losses to offset unlimited amounts of active income. Qualification requires meeting two stringent tests. First, more than half of the personal services you perform in all trades or businesses during the year must be performed in real property trades or businesses. Second, you must perform more than 750 hours of service during the year in real property trades or businesses. Spousal participation counts toward the 750-hour test. Crucially, you must also materially participate in the rental activity itself, typically requiring 500 hours of involvement in that specific property or group of properties.
Cost segregation is an engineering-based study that maximizes the depreciation shield by reclassifying components of the building into shorter recovery periods. Instead of depreciating the entire structure over 27.5 years, components like carpeting, specialized lighting, and site improvements can be moved into 5, 7, or 15-year categories. This acceleration significantly front-loads the tax savings. For example, 5-year property includes items like removable fixtures and certain electrical systems. 15-year property often includes land improvements such as fencing, sidewalks, and driveways. The Tax Cuts and Jobs Act of 2017 introduced 100% bonus depreciation for property with a recovery period of 20 years or less, allowing the entire cost of these segregated components to be deducted in the year they are placed in service, creating massive immediate paper losses. The tax savings generated by depreciation are not permanent, they are a deferral. When the property is eventually sold, the accumulated depreciation must be accounted for through a process called depreciation recapture. The gain attributable to the depreciation taken is taxed at a maximum rate of 25%, known as the Section 1250 gain. Any remaining gain above the original cost basis is taxed at the lower long-term capital gains rates, typically 15 or 20%. This 25% recapture rate is higher than the standard capital gains rate for many investors, making the timing of the sale critical. However, the benefit of deferring taxes for decades and using that capital for compounding growth often outweighs the eventual recapture cost. The 1031 like-kind exchange provides a legal mechanism to indefinitely defer the depreciation recapture tax. By exchanging the relinquished investment property for a replacement property of equal or greater value, the tax basis of the old property is transferred to the new one. This means the accumulated depreciation liability is carried forward, avoiding immediate taxation. The exchange must adhere to strict timelines, identifying the replacement property within 45 days of closing the sale and completing the acquisition within 180 days. If an investor holds properties until death, the basis is stepped up to the fair market value, and the depreciation recapture liability is completely eliminated for the heirs. This makes the 1031 exchange a powerful wealth transfer tool. Consider an investor in the 35% federal tax bracket who purchases a $1 million apartment building. Assuming a $200,000 land allocation, the depreciable basis is $800,000. Over 27.5 years, the annual straight-line deduction is $29,090. This deduction saves the investor $10,181 in federal taxes every year, assuming they can utilize the loss. If a cost segregation study reclassifies $150,000 into 5- and 15-year property and 100% bonus depreciation is applied, the investor deducts $150,000 immediately. This single-year deduction generates $52,500 in immediate tax savings. This capital can then be used for the down payment on a second property, accelerating wealth accumulation through leveraged tax savings. Maximizing the depreciation shield requires 3 strategic steps. First, ensure accurate land allocation to maximize the depreciable basis. Second, utilize cost segregation studies, especially for newly acquired properties, to front-load deductions using bonus depreciation. Third, structure your activities to meet the real estate professional status requirements if your adjusted gross income exceeds the $150,000 passive loss phase-out threshold. Finally, plan your exit strategy using the 1031 exchange to defer the inevitable recapture tax, maintaining tax-free compounding growth across multiple investment cycles. The depreciation shield is the single most powerful tax advantage available to real estate investors, transforming positive cash flow into tax-free income.